What is happening? Bitcoin Bulletin crew. Get ready for a rapid-fire news blast that's going to shake up your world. First up, we're talking about a staggering $37 trillion US debt that's igniting wild theories of a crypto and gold reset, with Bitcoin's price absolutely soaring. Could this be the moment the financial world as we know it is rewritten? Then, we're breaking down the latest analysis from CryptoQuant, exploring two critical scenarios for Bitcoin's next big move. Are we heading for more sideways action, or is a significant correction on the horizon? EgyHash has the insights you need to navigate these choppy waters. Next, we're diving into why Bitcoin's inherent scarcity is becoming more crucial than ever. With financial institutions eyeing purchases and miners producing less, we'll explore how this fundamental trait is driving value in today's economic climate. And finally, get ready for a shocker as we see echoes of summer 2023. Bitcoin's volatility is predicted to surge dramatically in October, mirroring past patterns that led to massive rallies. What does this mean for your portfolio? You won't want to miss this. Subscribe, like, and hit that notification bell so you don't miss any of these explosive updates. The US is trying to rewrite the rules of the gold and cryptocurrency markets. With the US debt ballooning to an astonishing $37 trillion, a seismic shift in the global financial landscape is being theorized, and Bitcoin is at the epicenter. This isn't just about market fluctuations, it's about a potential global financial reset. Top advisor to Russia's President Vladimir Putin, Anton Kobyakov, has put forth a startling assertion. The United States, under President Donald Trump, allegedly aims to leverage cryptocurrencies to erase its massive debt at the world's expense. This audacious strategy, Kobyakov suggests, involves moving a significant portion of the U.S. national debt into the crypto cloud, and then devaluing it, effectively starting the financial system anew. This comes at a time when Bitcoin's price has already seen impressive gains, with some bullish traders predicting it could reach $2 million per coin. The U.S. Treasury Secretary Scott Bessent has also signaled an embrace of stablecoins, believing they will bolster the dollar's global reserve status and increase demand for U.S. treasuries. Meanwhile, gold prices are surging alongside U.S. debt, sparking talks of the Federal Reserve revaluing its gold reserves. Russia, alongside nations like China and Iran, is actively seeking alternatives to the dollar-dominated system, making this alleged U.S. strategy a critical geopolitical chess move. The community is buzzing with theories about whether this is a desperate measure or a calculated play to maintain U.S. financial dominance in a rapidly changing world. Don't go anywhere, because the implications of this debt crisis could be far bigger than you imagine. Up next, we're analyzing the precise scenarios CryptoQuant sees for Bitcoin's next major move. Is Bitcoin poised for a sideways shuffle or a sharp correction? As Bitcoin hovers around the $112,700 mark, the market is grappling with uncertainty, and analysts at CryptoQuant are laying out two distinct paths forward. While large players, or whales, continue to accumulate the digital gold, the price remains stubbornly range-bound. The key culprit, according to analyst EgyHash, is a shift in futures market dynamics, now heavily influenced by retail traders rather than institutional whales. This is evident in the average order size, which indicates a stronger retail presence and a general decline in trading activity, signaling a consolidation phase. The cumulative volume delta, CVD, indicator also points to sellers gaining the upper hand in the futures market, fostering a bearish sentiment. Without a resurgence of whale activity and robust demand from major players, Bitcoin is expected to either stay within its current range or face further selling pressure. Despite a recent recovery above $112,000, trader confidence remains fragile, with many questioning Bitcoin's momentum to break the $120,000 barrier. Demand for options protection has increased, signaling a preference for neutral to bearish strategies, with expectations of a potential dip below $108,000. This caution is amplified by Bitcoin's inability to match the record highs seen in the S&P 500 and gold, coupled with weak U.S. employment data that strengthens the case for potential Fed monetary easing. Even with 100% probability assigned to a September rate cut, which could spark a crypto rally, ongoing outflows from spot Bitcoin ETFs, and increased accumulation of Ethereum by institutional players are weighing on sentiment. On-chain metrics show a stabilization, but transaction volumes and fees are down, suggesting a lack of urgency. Investors are cautiously taking profits, leading to a fragile stabilization above the short-term holder cost basis. Analyst BitBull, however, forecasts one more significant rally of 40–50% by November-December before a potential blow-off top, drawing parallels to patterns seen in 2023 and 2024. But what if the real story isn't about market movements, but about something far more fundamental? We're about to uncover why Bitcoin's scarcity is becoming its superpower. Bitcoin's scarcity, the ultimate hedge in a debt-ridden world. In an era of mounting global debt and fluctuating traditional markets, Bitcoin's engineered scarcity is emerging as its most compelling asset. With the U.S. debt surpassing $37 trillion and governments potentially loosening monetary policies, investors are increasingly drawn to assets with unalterable supply. Bitcoin's protocol hard caps its total supply at 21 million coins, a limit that is practically impossible to change without the consensus of the very holders who secure the network. The 2024 halving has further reduced the rate of new Bitcoin issuance to approximately 450 coins per day, a pace that will only decrease over time. This inherent scarcity is echoed by Bitcoin's largest holders, the whales, who are increasingly unwilling to sell, accumulating vast pools of ancient coins that haven't moved in over a decade. This long-term holder supply remains near record highs, indicating a price-insensitive cohort that prefers to HODL, thereby tightening the circulating supply available for new buyers. Adding to this demand are U.S. spot exchange-traded funds, ETFs, which aggregate capital from financial institutions and retirement accounts, leading to persistent inflows and a reduction in coins available on exchanges. Unlike gold, which sees continuous new supply from mining, Bitcoin's issuance schedule is predictable and shrinking. This compounding effect means that any incremental demand must compete for a diminishing float of tradable coins. While macroeconomic factors like global debt reaching over $324 trillion can introduce short-term volatility, they also reinforce the long-term investment thesis by potentially prompting looser monetary policies. As the European Central Bank and potentially the Federal Reserve ease rates, liquidity could increase, benefiting assets like Bitcoin. However, investors are advised to view Bitcoin as a long-term allocation, leveraging its predictable supply schedule and observable demand drivers, rather than a safe haven against immediate economic collapse. Think scarcity is powerful? Wait until you hear how Bitcoin's volatility is set to explode, echoing a pattern that ignited massive gains. Get ready for October. Bitcoin's volatility is about to skyrocket. Just as a tightly wound bowstring is ready to unleash its energy, Bitcoin appears to be building momentum for significant price swings in October, mirroring the dramatic patterns seen in the summer of 2023. After a period of relative calm, with Bitcoin trading between $110,000 and $120,000, market volatility expectations have softened. The Volmex Finance BVIV index, measuring 30-day implied volatility, has dipped to an annualized 38%, nearing a two-year low. Implied volatility, derived from options pricing, reflects the market's anticipation of future price movements. The current compression in implied volatility strongly resembles the setup from summer 2023, when it fell sharply before a sustained rally in October and the subsequent launch of spot Bitcoin ETFs in early 2024. This mean-reverting nature of volatility suggests that a period of low activity often precedes a significant price surge. The current lull in volatility could be an indicator that the market is underpricing the potential for future turbulence. If history is a guide, October might once again serve as an inflection point, potentially triggering a surge in implied volatility as Bitcoin experiences a notable price move, likely to the upside. This is further supported by historical data showing the fourth quarter as Bitcoin's strongest, with an average gain of around 85%. What a ride, but we're not done yet. Stick around for a lightning-fast recap of all today's top stories and a massive call to action. And that's a wrap on today's Bitcoin Bulletin. We saw how a $37 trillion US debt could spark a global crypto and gold reset. We broke down CryptoQuant's 2 scenarios for Bitcoin's next move, exploring potential sideways action or a correction. We highlighted why Bitcoin's inherent scarcity is more crucial than ever in today's economic climate. And we revealed how Bitcoin's volatility is predicted to surge in October, echoing past rallies. Don't miss out on any of these critical updates. Hit that like button, subscribe to the Bitcoin Bulletin, ring the notification bell, drop a comment with your thoughts, and follow us on all social platforms for real-time insights.